Hey, welcome everyone. I'm Ted Erhart. Here we are. It's the fourth quarter of 2022. In the last couple weeks, I've had a number of good conversations with clients that have naturally expressed some concern. The stock market's down significantly in 2022. And I've really spent a lot of time, talking with people about the backdrop of what's happening. So we are in the middle of a interest rate hiking cycle. The Federal Reserve is purposely raising interest rates to restrain economic activity in an effort to battle inflation. This is kind of a classic economic scenario. And generally speaking, rising interest rates are negative for stocks. And I talked about this all the way back in January when the stock market was at its peak. And at that point in time, I was thinking about, how 2022 was going to play out. The Federal Reserve, inflation was starting, the reports were coming in pretty hot at that point in time, and it was really a high probability we were going to see rising rates later in the calendar year. And given that, I started making some defensive moves in the money that I manage for clients, and frankly, in hindsight, I wish I would have done even more at that point in time, but hindsight's always 20/20, of course. But nonetheless, I'm going to patch in the video that I created back in January 2022 for those of you who missed it, because it is so fundamental to understanding the current market environment and why, as long as we continue to see rising interest rates, the financial markets are likely to be choppy. So I hope this is helpful. If you got any questions, please feel free to reach out. Here we go, back to January of 2022. In recent days, data was released indicating that inflation is running at the highest rate in almost 40 years. The Federal Reserve has responded by basically promising interest rate hikes are coming in the coming months. In turn, the stock market is down, which really isn't that surprising. And that brings us to today's discussion, why rising interest rates are generally considered negative for stocks. Let's get into it. There's actually many reasons why rising interest rates create headwinds for stocks. I'm going to focus on the two that I think are the most significant, those being the concept of the risk-free rate of return, and in addition, discount rates as it relates to valuing businesses. But I'm going to break this up into two parts just to make it more digestible. So today we'll focus on the concept of the risk-free rate of return. In finance, U.S. government bonds, or treasuries as they're officially known, are generally considered the risk-free rate of return. So in other words, if you wanted to invest for, say, 10 years without risking your principal, the first place you'd look, in theory at least, is the U.S. Treasury market. And that's what I have up here on the screen, the current yields in the Treasury market, at least as of the market close January 14th. So if you look in this column here, you can see where yields are, or the effective interest rate on treasuries given the various maturities. And the 10-year, which is where we're going to focus most of our discussion today, is presently yielding about 1.79%. So if you wanted to invest in 10-year treasury bonds today, or that is borrow money to the U.S. government, you'd earn 1.79% annualized over the course of the next 10 years. So this brings us to the question, why does the interest rate on treasuries matter to the stock market? And why do rising rates generally create headwinds for stocks? Well, you have to think about this from an investment perspective. If you're an investor, you're coming to the marketplace, you have all these different types of investments to pick from. There's government bonds, like we're discussing, and like I have illustrated here. Now, when you look at this and you look at the yields on these, they don't look that attractive. So a lot of other things, like stocks, like real estate, probably look better in today's marketplace. And I think that is basically, I'm just describing the theory of why asset prices are generally high today. It's because interest rates are very low. But imagine a world where treasuries are yielding 10%, 12%, even 15%. In other words, let me restate that. Imagine a world where you could buy a U.S. government bond that guaranteed you a 15% rate of return. The obvious question is, then why would you ever want to own stocks or real estate or gold, whatever the case might be, if the government was going to guarantee you 15%? on an annualized basis. My point is, as the risk-free rate of return goes up, this generally puts downward pressure on other assets that entail investment risk. Because at some point, as interest rates are rising, people start to say, hey, I'd rather own something on a guaranteed basis, or at least, more of that and less of this other stuff that entails a lot of investment risk. And guess what? The scenario I just described where government bonds were paying 15% isn't just hypothetical. It actually happened here in the United States back in the early 1980s. You can see U.S. Treasury notes, technically, were yielding in excess of 15%. At the same time, and I'm going to talk about this next, guess what? Stocks at that point in time were at some of the cheapest levels in history. And it makes sense, because why would you want to own risky stocks when you could earn 15% or more on a guaranteed basis? So the last thing I want to talk about here, it's a bit technical, so I'm going to try to simplify and be as short-winded as I possibly can. But this is some data put together by an economist, Robert Shiller. He's created a measure of stock market valuation. In other words, are stocks expensive or cheap? It's generally considered one of the best measures that exists, and it goes back about 140 years. And here's kind of all you need to know. Here's what I want to point out. This blue line is a representation of the expensiveness or cheapness of stock prices. I put in this purple line, which represents the long-term average. So in other words, anytime the blue line is above the purple line, stocks are more expensive than average, and obviously when they're below, they're cheaper than the long-term average. The red line represents long-term interest rates. And again, in an effort to be relatively brief here, what I want to emphasize is notice when interest rates have peaked, like they did in 1981, and likewise in the early 1920s, take a look at how cheap stock prices got. They're about the lowest levels in the data set. So my point is, it's not a coincidence that stocks have tended to touch their cheapest levels right at the time that interest rates have been at their highest levels. So in short, one of the principal reasons rising interest rates are negative for stocks is they create competition. As interest rates rise, again, at some point, things like government bonds and CDs start to look attractive, at least in comparison to riskier assets like stocks and real estate. And as money shifts from riskier assets into safer assets, it puts downward pressure, obviously, on wherever the money's leaving. So that is part one of our discussion on how interest rates, at least rising rates, are typically negative for stock prices. In part two, we're going to talk about discount rates, which has to do with the way in which stocks are valued. So tune in for that one. But if this made sense to you, let me know by giving me a big thumbs up if you're watching on YouTube. Again, thanks for watching. I hope we'll see you in the next one.